And I really think that what has now been proven is that this decentralized model in creative heavy industries like gaming just does not work. And again, when you're in a creative endeavor like gaming, I think it requires really, really high levels of centralized oversight, support, synergistic effects. And these companies, especially Embracer, had none of that.
Hello, everyone. Welcome to Pixels and Profits. Today, we are joined by Chris Petrovic, former SVP and head of corporate strategy, M&A, and business development at Zynga, and largely credited for most of Zynga's very successful acquisitions over that huge run-up. Was it like 5 years, Chris? I don't remember exactly how long it was, but it was arguably
Almost.
one of the game industry's most successful series of acquisitions that we've seen. And Chris is now Chief Business Officer at FunPlus, company that I also worked at and have a lot of respect for and root for. And I would say there may not be anyone better to weigh in on synergies from M&A and how bundling at an organizational level can add overall synergistic value or not. Chris, welcome to Pixels and Profits. Along with you, Chris, we've got our regulars, the Pixel Brothers, Brian Peganoff, Matthew Conterman.
Sounds like a tag team wrestling match. Yeah.
Top row. Chris, is there anything else that I'm missing from your background that you want to perhaps weigh in on? Or maybe you could tell us a little bit more about what you're doing at FunPlus right now.
Yeah, no, thanks, JK. Appreciate being with you guys. Big fans of the show and looking forward to this chat. Yeah, so FunPlus just helping Andy, our CEO, run the company. We have a kind of a split organization from a footprint perspective. We have over almost 2,000 people split across Asia, mostly in China. And then we have a European presence across 3 cities, one here in Zurich, where it's the global operational headquarters of the company where I'm based. And then we have an office in Barcelona that houses our publishing group, as well as a new game studio focusing on hybrid casual. And then we have a AAA IP studio in Lisbon that we started last year that's also ramping up. So working on those with those teams and really focused on continuing to try and grow the company.
Great. All right. So for our audience today, the main focus of discussion is going to be what happened with Embracer in terms of a company that went through historically a series of mergers and acquisition, rolled up a lot of different companies and then split up. But I think the more general question that I have for this group today is to try and understand moving forward in the games industry, like what level of scale gives you the most competitive advantage? Like how much scale is optimal given the new environment that we're in? How much was due to ZERP? How much is due to actual synergies, things like that? And maybe where we could kind of first kick it off is, I think, Brian, were you going to go over the current kind of status in terms of Embracer, the breakup kind of summary of what's happened? Maybe we could speak to the audience in terms of the current situation with Embracer.
Yeah, we can cover that real quick. It's funny because we were just doing an episode on what Ubisoft versus Embracer, kind of calling them both dead money and wondering how they're going to move out from where they are. Maybe like 4 or 5 days later, April 22nd of this year, Embracer decided to split up its company into 3 separate entities, and we'll call them Asmodee, Coffee Stain, and Middle Earth Enterprises, because I'm not going to say and friends. All of these we listed individually on the NASDAQ Stockholm Stock Exchange. So Asmodee is a leading tabletop games publisher and distributor. Coffee Stain focuses kind of on that indie A, single A, double A, free-to-play games for PC, console, and mobile. And then Middle Earth is kind of like your cleanup hitter, AAA developer and publisher of PC, console games, and IP owners. And if you look at it, like they split it up into 3 kind of bite-sized pieces, right? Like net sales or, net of fees for each of them is between like 1 and 1.3 billion USD. The margin is much different, right? Like Asmodee is a low, slow grower, mid-teens margins, Coffee Stain in the 30 to 40% range, and then Middle Earth Enterprises in the high 20s. So that's kind of where we're at right now. Matt, don't you have like a few points on like when this is going to happen? And we have some time, I think, right?
Yeah, absolutely. So they did kind of point out that this is going to take a long time. Spinoffs like this take a long time. And just like mechanically, this is going to happen as a spinoff to shareholders. So existing shareholders of Embracer, they get new shares in all of these and friends companies. Sorry, Brian. But so, and in theory, these transactions will be tax free. So that's part of the time it's going to take. They're expecting to do the spinoff of Asmodee, I believe, within 12 months, and then the spinoff of Coffee Stain sometime in calendar 2025. So all of this expected to be done roughly in the next 18 months. So to answer your question as why does this take so long? It's really complex to unravel these things. It's really complex to separate the assets legally and then do all the tax analysis as well to make sure that this is a tax-free spinoff. So there's no added cost to shareholders to doing this. Because, you look at some spinoffs that have happened in other industries. I mentioned before, I worked in like covering telcos before. They do a lot of this where they all conglomerate and then they spin off assets. And sometimes those spinoffs aren't tax-free. And that has a really negative impact on the parent company in terms of the shareholder value of that spinoff. And so they're going to do their best to make sure that all of this occurs the right way, but that takes a long time.
All right. And as Chris, when you look at Embracer and you think about your own history at Zynga and what a successful sort of combination looks like relative to what you saw at Embracer, would you characterize how would you characterize what happened and potentially what you think they could have done for the organization to make sense in terms of a combination of assets?
Yeah, it's a great question, JK. This deja vu for you and I, because I think we talked about this maybe 2-3 years ago, shortly after it
Yep.
happened, in the context of analyzing both Embracer and Stillfront,
Mm-hmm.
and trying to make sense of these decentralized city-state organizations, being kind of a new flavor then, in terms of how to bring games to market, game companies to market, how to deploy capital. And I really think that what has now been proven is that this decentralized model in creative heavy industries like gaming just does not work. I mean, we have proxies in the public markets in the past. Interactive Corp was an example of, loose confederation of states all trading under this moniker of being digital assets. Berkshire Hathaway, very famous for also just being an asset holder. But those are very different times and very different businesses. And again, when you're in a creative endeavor like gaming, I think it requires really, really high levels of centralized oversight, support, synergistic effects. These companies, especially Embracer, had none of that.
And Chris, when you think about, and to the extent that you can speak about it, when you think about the Zynga model and in terms of like what Central did and the kind of synergies that you saw in a successful sort of M&A scenario, could you speak to what that looks like to you?
Sure. So first of all, it leads with a coherent strategy. Yeah, and from the time that Frank got there, along with the rest of us that joined him to turn the company around, it was very clear from day one on what the strategy was going to be, which was leaning in on forever franchises and leveling up the portfolio, both through organic reorientation, meaning the existing forever franchises, getting those demised, and then bringing in new forever franchises through M&A. So it's very simple. Very straightforward, wasn't rocket science, but it allowed us to be very fast moving, very nimble, very focused on what we wanted to bring in. And I think here you saw just the opposite. It was, really to me seemed like a multiple arbitrage led strategy. I mean, obviously at Zynga, we benefited from multiple arbitrage, but that wasn't tip of the spear. It was a great outcome. And we also were really diligent on the fact that all acquisitions had to be accretive, because one of the strategic pillars of the company for the turnaround was that we had to improve our EBITDA margins to be in line with best in class. And so we were never going to do deals of any scale that were going to be dilutive. So that cuts out a bunch of opportunities. Obviously, if we didn't see a path to a forever franchise in a game or a studio or a team, that also cut out a lot. And it just seemed like when you have a solo executive, basically, leveraging the public markets, for his own, what seemed like somewhat personal desires to amalgamate stuff that he was really just a fan of, and letting them operate completely independently without any mutual benefits. It just seemed like a recipe for disaster then. And I think, the history has borne it out now.
Chris, I got a question for you about, kind of thinking about Zynga versus Embracer in that sense. I remember, from the outside looking at kind of Zynga's M&A strategy, call it while you were there, 2016 to like, before COVID, basically, right? When they were doing a lot of deals, it all seemed to be, there seemed to be like I'm not going to call it a target size, but it seemed to be like there was a size range that you guys excelled at, that you kind of, the deals ended up within a certain range. certain revenue profile, certain stage of growth. I remember Small Giant, you guys brought them in right before they launched the game, and you were able to help scale that game with the resources of Zynga. Curious, well, A, is that valid? And then B, when you look at Embracer, I don't see that. It's exactly what you were saying, right? You kind of see this just valuation arbitrage strategy, financial engineering strategy, kind of getting whatever they could get their hands on.
Yeah, it's a great question, Matt. I think you're giving us a little bit, maybe too much credit because of the headlines of some of the bigger deals. But when I got there, you guys may remember from being in this industry that Zynga, up until that point, did not have a great track record of being successful on the M&A side from a return perspective, and so we had to, both internally as well as for the public markets, as well as for the industry itself, we had to kind of reinvent ourselves and start from scratch. And our first deal that we did was for a crossword puzzle game. That
Harpan,
was,
right?
yeah. That was no
Yeah.
Harpan was the solitaire game. We bought a daily crossword puzzle game that was a sub $50 million deal, and then Harpan was an asset deal after that, and then we bought the board and card studio of Peak, and then Graham, and then Small Giant, and then Peak. So we kind of progressively gave ourselves permission as we proved our ability to execute M&A and do the proper levels of integration on a per deal basis, give ourselves permission to unlock access to more capital to do larger scale deals. Because look, at the end of the day, when you start doing those deals and you get more successful, smaller deals of the previous transaction size, there's diminishing returns on doing those kinds of deals because they take the same cost and effort, but don't yield the same materiality. So we naturally had to go up, but that would not have been possible but for those early deals where we actually proved to ourselves as a leadership team and as a company, and also to our board and shareholders, that we actually could do positive, accretive things, with the money that we had on hand.
Chris, what about like the function of time, right? So from 2016 with the first two transactions and then into 2021, how did you see the market changing from your seat? Obviously, a lot of more competition, but did things start to seem a little bit off the wall to you?
Yeah, I think the only thing that was really hitting me toward the tail end there was as we closed peak on basically on the eve of COVID, was the fact that COVID was going to change dynamics. And I was a little bit off back then because I actually had predicted publicly that I thought deal volume in general across games and consumer tech was going to decrease over COVID because of the lack of interpersonal interactions, which I always invest in as being super important. And I couldn't have been more wrong. But I think we can get into why that was the case in a second and talk about whether that was a good thing or not. But we also hadn't yet fully grasped the gravity of the potential of what IDFA was going to do. I think it was far enough out still that it wasn't impacting our day-to-day decision making. We were talking about it a lot. We were trying to figure out what it would mean because, again, it was so opaque that we didn't really have transparency into it. So there weren't really any existential things other than the looming COVID lockdown that interrupted our flow of M&A, I would say, for a little bit. Although even with my departure, the company and the team was still going strong. With Rollick was actually my last acquisition, not Peak, if I remember the order correctly. But even after that, they bought an ad network, they bought a Chinese developer, they did an acqui-hire to support their cross-platform ambition. So stuff was still happening, but COVID was really for me, with the big harbinger where I thought things were going to change, but not necessarily negatively impact our business.
And maybe one of the questions I could ask all three of you guys is that what is there a scenario in which all of these assets that Embracer had acquired together makes sense? And to the point that you made, Chris, about having a specific strategy and finding specific synergies, was there a scenario where, or what could they have done to make all of those assets combined make sense? Or in the current market, is it better that they are split off?
Well, I think the order of preference in terms of what they did and how they did it was really strange to me. To me, my philosophy is always, if you're going to go into a category or a sector, that you have to find kind of your anchor that's going to be the center around which all subsequent activity revolves. And for example, Gearbox, in my mind, should have been an earlier acquisition to be kind of the tentpole for any and all kind of AAA IP creation that they wanted to do after that. But it was always strange to me that, leading up to that Gearbox acquisition, there was always this kind of manic quarterly acquisition spree where they were cobbling together a lot of subscale assets with the goal of announcing them all at one time and making it seem like it was dressing it up in a way that everybody could see right through it, right? That you're not going to announce these individual acquisitions. You're going to announce them as a bundle. But when people started trying to see what was the connective tissue between and among those bundles, there really wasn't any. And so I think that, in my mind, one of the mistakes was not really anchoring on something of substance and scale that could be the focal point or the hub around which all the other spokes could connect and benefit from, because they didn't have any central, hub to begin with, right? So I think in any of those cases they should have had that, and it just seemed like a little bit all over the board. Again, with the exception of Gearbox, but that happened so much later in their cycle of their acquisitions that by that point it was just it just kind of added to the confusion.
Yeah, I think that's spot on, right? And this, and kind of what you alluded to earlier as well. There was no centralized functions for all of these add-ons to anchor to, right? So, I think, and I go back to the podcast you did with JK when you left Zynga. It was at 2021 before you joined FunPlus, and you talked about kind of having a menu of options and ways to integrate, different teams. There's no menu of options at Embracer. It was just, all right, now keep doing the same thing you're doing, or and here's some earnouts, or maybe, okay, now you're part of this publishing group but you still do everything yourself. There's no centralized marketing, no centralized publishing, nothing that could drive any sort of synergies other than value from financial engineering. And so that's, for me, JK, kind of, I know you wanted to talk about what could have made this successful. I think you kind of alluded to it as well in your question. Well, if there was no debt involved, then theoretically they wouldn't have to break up the company, right? Because the real catalyst here is the debt, is the debt covenants that were looming. And now they're going to dump the debt with the board game company, which, to Brian's point, is a slower growing, but it's a much more cash flow accretive business because it's much more mature. So debt investors like mature cash flow accretive businesses. Debt investors struggle with gaming. Only the largest AAA publishers have had, significant debt, and only recently EA, Activision, et cetera, right? And so I do think that if they wouldn't have gone as big as they did, and they would have focused on, only using the cash and equity they had and not taking on all this debt, they could have survived in their current form. Now, would that still be a viable investment opportunity? I mean, that's probably not, for my opinion, but I do think the debt was a key catalyst here that's driving this breakup.
I think also it's just kind of a victim of circumstance too, right? Like it worked for a time. The company was at one point $16 billion in market cap. Gaming was at a different time. Now we're going through this minor gaming recession, a lot of layoffs. Gaming time and spend is down demonstrably from COVID peaks. So yeah, I'm sure that some people that work there probably just stay maybe waiting for another COVID to happen or something like that for this. But it really was just the worst possible time to call the peak there, and continue to do deals even thereafter. A lot of dilution as well. Some of that comps to the studios was stock based. So it's just, unraveling of those things can happen very quickly. But, like I said, it did work for a time.
Yeah, Chris, I got a question for you, kind of dovetailing what Brian just asked, in the sense of during COVID, after COVID, call it 21, 22, there was a ton of influx of capital into gaming, both gaming endemic investors, whether it be corporate, strategic buyers, whether it be VC, with much larger purses now, because whether it's the LP said, hey, we want much bigger slice of the pie or whatever. And then you also had non-gaming endemic money, plus you had Web3 money coming in, et cetera, right? And so curious how that affected your thought process as someone who's been in the industry a lot longer and done this, what you saw. To your point, it got more competitive, which you weren't expecting, and deal volumes went up. And then also kind of how you think about navigating that kind of environment. And I think as it ties back to Embracer, they were a key catalyst as well. These roll-up companies, buying assets at inflated valuations. I know, Brian, we've talked about your experience as well, seeing some of this, but I'm curious what you think about all of those things together.
Yeah, watching all of that transpire during that time was mind-boggling to me and astounding. And on the one hand, it's hard to fight the inertia force of the market. If the market is moving a sector in a certain direction by the influx of capital and the relative low cost, and it's hard to resist that, whether you're a buyer or seller. It really is difficult because you have to continue to show growth, or you have to show great returns for your investors. And so for both sides of the table, it seemed like an opportune time to transact. And even with the COVID restrictions of actually doing deals completely virtually, which I would love at some point to try and do a deconstruct of the success ratio of deals that were done during that COVID time. Not so much the capital raised, but in terms of just, success, because it's really hard to establish those long-term relationships if you're doing it all by email and by video call, especially when you're dealing with those kinds of dollars. I think the other thing too that always struck me was just how many smart people are involved in these processes, whether it's Lars and his team in Embracer, or whether it's investors that just didn't acknowledge the pattern recognition that our market is always cyclical, and not just us as a gaming industry, but the stock market and recession trends, that they're all very cyclical, and that there was not going to be this endless up escalator that was going to permeate our industry and set a new floor for us from a year over year growth perspective. And that is, to me, is existentially always the most interesting thing and mind-boggling thing, which is how can so many smart people not call the ball right on these kinds of things and temper their enthusiasm, with these kind of future risks in mind. And like I said earlier, the inertia is so difficult to resist when you have that perfect storm of growth rates, people wanting to get into the sector that have been on the sidelines, low cost of capital. It just seemed like a perfect storm of opportunity for people to benefit from.
And maybe Brian and Matthew, before we kind of move off of Embracer and talk about M&A and kind of like the outlook more generally, what do you guys think about these kind of split off companies? Do you guys have a view in terms of the outlook and just like the attractiveness of these three separate companies and their potential? I guess they're all going public, right?
Yeah. Well, two are going public and then the other one's getting renamed. Same thing.
Yeah. I mean, I think obviously valuations matter and capital market situation matters. And when we get 18, 24 months from now, and a lot can change between now and then, but I think at the right price, both the Middle Earth enterprises and the coffee stain businesses are attractive acquisition targets, especially if they don't do any of these synergistic moves that we've talked about, right? If they don't take advantage of centralized publishing, centralized marketing, et cetera, you can see a world where, an Xbox who wants to fill out the Game Pass catalog, but their strategy is also kind of weird right now. Are they doing fewer, bigger, better? Or are they still investing in Game Pass? I don't know. If they're still investing in Game Pass, Coffee Stain actually, I think, is a great acquisition for them. This kind of collection of AA games, single player games that are 10 to 15, 16 hours long of playtime, right, total. That's great for a subscription business. And they can also then go through and cut the axe and centralize publishing, centralized marketing, all inside of Xbox, et cetera. So like something like that kind of makes sense. Or maybe even for Netflix. Like, I don't, who knows what Netflix's gaming strategy looks like in 18 to 24 months. Chris, you're nodding, so you kind of agree. And then I think Middle Earth, just because of the IP that's there, I think there'll be plenty of interest in that business for Lord of the Rings, for Tomb Raider, et cetera, et cetera. I think that both of these businesses actually get quite interesting from an M&A perspective.
I think my gut check reaction to this was kind of like, oof, like this company's already getting so small, and now you're going to split it up into three. And coming from experience and working with a company public that was subscale to begin with, it's very daunting. It's very challenging. Zynga too. Like Chris, I think when I first started covering your company, there was $600 million of revenue. I know that was extraordinarily tough. Volatility is insane. There's the quality of investors that look at stocks that are that small. They're often looking at really obscure numbers every quarter, and that can cause a really big shock to the stock, T+1 anytime you print. But each of these businesses is over $1 billion in revenue. I think that cost of operation, where the size is adequate, has gone up over time, especially as the gaming industry has gotten more competitive. But it's not nothing. I don't think these are institutional grade names necessarily because they are very small. I think they do, to Matt's point, look more like acquisition targets, especially if something gets something going in the right direction, a new hit. They're also a lot more sensitive to hits as a smaller organization without so much diversification. So there's double-edged sword there. But also, like when you acquire companies, part of that lift is from redundancies, right? Like you don't need two CFOs, you don't need two HR functions. This is going to go the other way. Costs are going to go up from an infrastructure perspective. And I guess like Asmodee, the one silver lining there is they're going to get a different kind of shareholder, right? There's investors that just invest in toys and IP and things like that. Like Hasbro is a big stock in that regard. So maybe they find more lift in that direction outside of the gaming vertical. But look, something had to change, right? Like this is a distinct change in narrative. Now these three new CEOs have their own chance to carve out their success in public markets with their own narrative, their own capital allocation strategy. So, I think all those things considered, I like it. It's worth watching. But again, there's still a lot of challenges and potential pitfalls for each of these companies. This is a tough industry to operate a public company, especially at that size.
Do you guys know what is Lars's involvement going to be across these three companies? Is he going to be chairman across all three, or just be CEO of one, or how is that going to look?
I think for now, this is going to take a while. So he's still the CEO and chairman of Corp. I don't. I think he's going to be on boards for all three. Matt, we were chatting about this like a while ago, but it's not super clear in the notes.
Yeah.
Yeah, I'm gonna have to go back and recheck all the information they put out. I don't think they clarified it, to Brian's point. I think they identified kind of like who's going to be the COO, CEO of each. It would make sense for him to step back and be on the BOD, which, to be honest, that's kind of, even though he's the CEO of Embracer today, that's effectively what he is, with how how the corporate entity is structured, where you have all these kind of independent subsidiaries. So that makes the most sense. And I mean, look, I've met the guy briefly. I've heard him speak several times. He's very smart. He's not a gaming person, right? His background is in video game and comics retail, I believe. I believe that's where he got his start. So it makes sense for him to take a step back. He's, even with the ups and downs, he's made a lot of money. Very good for him. But it's the right time for him to step back as well, I think, in that sense.
Yeah, I think the interesting thing will be to watch the performance of these stocks, because as you guys alluded to in the beginning of the call, these are public company stocks that will be traded in Stockholm, right? They're not going to be on any U.S. exchange. And we know from history and experience that when you see gaming companies traded on public markets that are maybe secondary in size, whether it's in Poland, whether it's AIM in the UK, whether it's Stockholm, that the constituency is different, right? And the level of sophistication is different. And I mean, you look at historically the companies that are public in Poland and the multiples that they have commanded, or even in the Nordics, right? The Nordic Nasdaq, right? That they are a different filter and a different breed of investor, a different type of investor that sometimes overinflates the value, because these are scarce assets in terms of interactive gaming assets that would otherwise be treated more as commodities on the US public markets. And so, to your point, costs will go up, valuations may be still out of whack for these companies relative to how their peers would perform in more mature public markets. So it'll be interesting to see in the medium to long term if they can right size it or even provide good exit opportunities for their shareholders because of the profile of their value and their cost.
You've got a lot of European-based funds that can only own European stocks, so they have just a few choices, and this might be three new ones.
I would add volatility to your list of things as well. Volatility is also a lot higher. We've seen that. Remember, CD Projekt went like this and this. These Nordic stocks have done this, right? So there's a lot of volatility because, to Brian's point, institutional money flows in like a tidal wave and flows out. You don't have the steady, stable investor base of passive funds like you do for U.S. listed large cap names. So you definitely
and very low volume too. Like the hedge fund complex in the United States moves a lot of shares. It's not the case there.
Yeah. I do remember before all of this restructuring and spinoffs, and Embracer wanted to like uplist to whatever the bigger exchange in the Nordics is, that they wanted to be, fully IFRS compliant and uplist and blah, blah, blah. And I don't think they ever completed that with all these changes. So it's maybe, who knows when all this is done, if that comes back on the table, because to Brian's point, if they can uplist to like the more senior exchanges in Europe, that also helps them attracting more stable capital, because there are some, large funds that can't invest if you're not on certain exchanges.
Hey, Chris, maybe one general question I can ask you about success with M&A is essentially, like you had stated that with respect to Embracer, like you need to start with a strategy. Certainly there needs to be some level of synergies amongst the assets and the companies that are bundled together. And then there was like this discussion about execution. Matthew, you had mentioned that, Embracer potentially could have survived if they didn't have so much debt. And Chris, you had mentioned that at Zynga, you had, kind of incrementally done bigger and bigger acquisitions, and maybe Embracer took on a little bit more than they could chew. So there's like the strategy, synergy, execution, and how that was executed. But then also was hoping I could ask you about like the integration. One of the things just running a game studio that has become very clear to me is just how much execution matters, right? Like the specific relationships. It's not just a strategy, but how you do it. And wondering if you could speak to like how important is that in terms of like after integration, how you work with that studio, and like maybe some of the like the dangers, the risks, or like how do you do that, the integration part right?
Yeah. I don't know that I can give you a single silver bullet answer, but I can give you my perspective on how I've treated integration during my history at Zynga and even before. And I will say that as between the deal making and the post deal integration, the latter is everything, right? I mean, not to oversimplify things, but I think the art and the science of doing transactions is rather straightforward and simple. You do some due diligence, you get to know people, bankers and lawyers get involved, they paper it, you agree on stuff, and all is on paper, right? And it all looks good, and everybody is aligned, and we can get to that as well, because I do think there are some aspects that are super important. But as we all know, 20% of deals drive 80% of companies' values, and the success rate is in that 10 to 30% range of successful M&A, however you define that. And so I think we have a long history in our industry and beyond of seeing too many things fail. And it starts with misalignment within the acquiring side, within the selling side, and also misalignment between the two parties leading in. But it also fails on the acquisitions. I mean, on the post-acquisition integration side, even more so, because nobody feels that it's important, right? Everybody feels that the hard work is done with the deal. It's business as usual, the day after, and everybody just operates as they did before. But, you're in a new relationship, right? And so the way you behave and the way you act in this new relationship is not how you acted or behaved before. And, and part of what led to the deal was a belief that 1 + 1 could equal 3, as I like to say. And so unlocking that value for both sides' benefit is really necessary, but also really individualized to each deal, because each deal has its own requirements. And it obviously starts with the fact of how a deal is structured. And if by definition you have you have contingencies like earnouts, for example, that definitely dictates how you as the buyer interact with the seller, because the one thing you want to avoid as a buyer is to be accused at some point down the road that you interfered with the seller's earnout ability to execute against, right? And so the way that we handled it at Zynga was this notion of doing less to do more, meaning that we tried our best to keep minimal level of contact in terms of day to day with the studios that we acquired. And that came about very quickly because we had a combination of experience from myself when I was at Kabam and watching some successful M&A there, and then the folks that came in from EA that had seen their fair share of failures on the M&A front, and then us all coming together, sharing those experiences and saying, okay, well, what can we bring to the table from those learnings to make sure that we can be successful and beat that hit rate. And what we realized was, and I'll never forget this, that in many of our early deals, in fact, not in all of our deals, the working group size of people that were involved on the Zynga side was sometimes larger than the total number of heads that the studio had that we were acquiring, right? So when you think about if each person sends one email a day asking for something to the CEO or the founding team at the target, it ruins their entire day and takes their eye off the ball. And so what we did was we had a very rigorous process in terms of communication and interaction with the folks on the other side, both before and after. And as Matt alluded to earlier from prior talks, we gave them the menu of options of things that we could offer them and made it completely opt-in, because we wanted them to feel like they were in control of making decisions as to whether or not they wanted to benefit from our data science, whether they want to benefit from our great rates that we had with the ad networks because of how much money we spent, whether they wanted to benefit from our central tech stack and all of the different SDKs that we had that could add in benefit. But ultimately, we left it to them to decide, and it became very organic when they ran into issues or where they saw how our games that had all those things integrated were performing relative to theirs. It was very easy for them to raise their hand and say, hey, can you tell me a little bit more about this thing on the menu? I'm really interested because I'm having issues with this, or I don't want to invest in that. And the first thing that always falls very easily is the central support services, right? Accounting, HR, legal, finance, all the things that you as a small studio do not want to invest in. An ad sales team, those things were very easy conversations to have. And the closer you got to the product and the monetization, the longer those things took to be able to feel comfortable. But leaving it in the hands of the new addition into the team, into the organization, to opt into the things that you can offer synergistically is key for us. And by the way, we also didn't add a lot of, in the deal models that we did, we never added a lot or ascribed a lot of value to synergy. We didn't have some inflated number that said, oh my gosh, if they use all of these things on the menu, it's going to be 40% synergistic, because it's just not true. If you could get maybe 10, 15% synergy lift from them opting into things over time, that was a great outcome. But again, it wasn't something that we relied on for our deal models at all.
So after hearing that, just imagine how much of a disaster it would have been to unbundle Zynga into 4 different public companies with all of those things in play.
Yeah.
Well, so I guess,
yeah. Yeah.
Embracer not doing that made this a little easier, I guess.
Ironic. Yeah, that's true. I mean, the counter to that, though, is that we were all very synergistic operations. The only thing that differed was the genres that we were in, right? It was all free to play mobile gaming that had some combination of IAP and ads, with a great data warehouse support behind it. So I think from that perspective, we weren't trying to unbundle a Frankenstein. If an unbundling would have happened, it could have been a little more discreet. But to your point, probably would have been more difficult because of all of the connective tissue.
Yeah.
But still, Brian, don't give Strauss and Laney more ideas.
Yeah.
So, Chris, maybe we could dive into this notion, this concept of synergy. And I would love to hear your take in terms of, like, in this new environment, like, we're not going to see a lot of M&A based upon, kind of multiples arbitrage anymore, probably, or at least for the near term future. Or feel free to disagree with me if I'm wrong on that. But it does seem that there are certainly advantages to scale that give you competitive advantage. I think most recently I had spoken to a few companies that talked about the value of cross promotion and looking at what they call portfolio LTV. And certainly when you see, like, for example, you could take Scopely as an example when they acquired Stumble Guys and the ability to acquire a lot of users organically and then to shift those users to a higher monetizing game like a Monopoly Go or something like that. There's as an example of like cross promo and portfolio LTV. Brian had talked about cost savings through consolidating central functions. I think that when you're at a certain level of scale, you are able to get better deals from vendors and just reduce kind of costs and things like that. But maybe it'd be great to understand your current thinking as far as the kinds of synergies or advantages that you would see in terms of that 10 to 15% that you think is possible. And then what is the ideal level of scale in the current environment?
Yeah, I think on the synergy side, like I alluded to before, I always had a really rational view, as did the rest of the team, the leadership team at Zynga, around the amount of synergies that we could that could be realized. Again, because we didn't force anything
Mm-hmm.
on the front end. I think that there are certainly ways that you can impart synergies. I know that Take Two, as you alluded to with Strauss, you mentioned him earlier, that they were very vocal in terms of the cost synergies that they were going to be able to realize as a way, I think, of probably placating the market around justifying the cost of the acquisition. So that really was maybe more of a public market PR necessity rather than than something that they wanted to be as vocal about. For us at Zynga, we were fortunate enough that we were acquiring studios, I would say, even up to Peak, because Peak, for all of its size and scale, was only about 100 people, right? So we were not acquiring huge headcounts. And the places where the synergies were most realized, like I mentioned earlier, was in those central functions. So we didn't have to duplicate, or they didn't have to add, any more people to legal, finance, accounting, HR, all of the things that they lightly invested in, but could keep at that level. And then we ended up creating like a matrixed working relationship with those folks at each of these studios, so that they had connectivity into the mothership, but could still run their day-to-day business as they saw fit. I think for things like cross promotion, perhaps things have gotten better over time with your example of Stumble Guys and Scopely. But, to me, that was always a little bit of a red herring, because it was much more of a promise than what actually materializes in terms of the behavior pattern of players, going from one game to another just because it's in the same portfolio. Obviously, you can run in-house ads and try and do all of those things. But if you apply natural conversion and click-through rates on that, it's not going to be some panacea of ultimate benefit. And then you also have to be very careful, because you don't want to bring the highest value players from one game over to another that have no certainty that they're going to be equally high value players as they were in the other games. So to me, cross promo, we saw some success, like at Zynga, for example, in Social Casino and Match 3, because there was a lot of audience overlap, and we actually also had the same IP in both of those gaming experiences. So there was two levers that we pulled, which is overlap of audience and then IP affinity. But I think Stumble Guys to Marvel Strike Force, or Stumble Guys to Star Trek, or Star Trek to Strike Force, like those are all things that I think conceptually sound good, but I really don't believe that is kind of a, like I said, a panacea of success. I think it's quite limited in its benefit, and could in certain spots help, but I think it's not something that drives the bus.
Right.
could also end up being extraordinarily expensive, right? Because if you're deviating a player from one of your wholly owned titles to a company you've partially acquired, then pay an earnout on top of it, you're that math doesn't quite work out. And we had a lot of pitches at Glue. We had a captive audience of female gamers that played Covet Fashion and Design Home. We often had companies come to us and say, "Hey, like, this is our game we've built, and you can send your players from Design Home." Like, well, why the hell would I do that?
Yeah,
doesn't make
why?
sense.
Exactly.
The other thing I want to just hit on, JK, is kind of like the concept of scale overall that you kind of brought up is it's kind of messy and gray in the sense of Embracer as a consolidated entity is almost $4 billion of revenue, right? Like that makes them one of the biggest players in gaming just by total revenue. So in theory, they have scale, but where they don't have scale is in a studio level or a title level. So they're not getting the economies of scale that you would expect from a business with $4 billion of revenue relative to a business with 100 million, because that $100 million revenue company might only have 10 employees. Embracer has thousands and thousands of employees. Chris, to your point, when you're buying even Peak with only 100 employees, the economies of scale within that studio already are so good. And so I think, there were for a long time a lot of maybe more so it was focused on AAA, but I think even these dynamics bled into the best in class mobile studios, which is fewer, better, best. And I think maybe it was because of COVID and the shift in engagement metrics and revenue and everything happened in the industry. We've gotten away from fewer, better, best. And I think part of the layoffs that have permeated the industry in 23 and this year is also about slowly getting back to that fewer, better, best mentality, in the sense of we need to make fewer games. Each game has to be bigger. Each game has to be more profitable, has to be more live ops driven, et cetera, et cetera. And I think we're getting back to that with a lot of the structural shifts in the industry. It just takes time to get back to that.
And Chris, maybe one other question I can ask you is I'm trying to remember who I spoke to, but this was like years ago. But I think I spoke to somebody at Zynga. I think it was Scotty K, who also spoke about sharing of best practices between studios or something along those lines. And so, to what degree? And I know, like in in the further past, there was like a lot of lawsuits and things from the Zynga playbook that got stolen and things like that. But like, how much of the synergy or incremental improvement do you think could be ascribed to like certain secrets, trade secrets, best practices from one studio being exported to other studios that then actually see some kind of uplift?
Yeah, it's interesting because those kinds of synergies that Scotty's talking about, and he was a primary driver of that, he and his team. Because what would happen? So two things would happen in those scenarios where you're talking about best practices. Number one is a studio would run into an issue for the first time in their lives, right? So, for example, there was, I remember with Graham, we had an issue shortly after the acquisition where they had some kind of currency inflation issue because of some mistake that they made in how they were pricing currency. And all of a sudden they had to create these sinks to get the currency out of the ecosystem, and they weren't really sure what was going on. And we were lucky enough as a company and as a leadership team that, Zynga up until that point had 10 plus years of both successes and failures of free to play games. And so the treasure trove of data and analytics that we had, that we could just plug into these companies and take the data that they were experiencing in their game and show pattern recognition across the 10 years of data to give them answers and solutions on how they could fix their issue. And in some cases, we would offer up resources of people to embed themselves for anywhere from 3 to 6 weeks in those studios to fix these discrete issues and then immediately leave because we didn't want them to feel like we were there overstaying our welcome. And those kinds of ad hoc things, were added a lot of value. I would say more from the relationship and trust level than actually being able to chart how much it improved the financial efficiency of that group for that event or for that amount of time. And then the second part, which is I alluded to it earlier, is just the access to the data. So when you're a young studio that's maybe on your first game, trying to do your second, and you're trying to figure out go-to-market strategies, product market fit, et cetera, you're only as good as what you have built, and that building is, the data set is quite limited. But if you can benefit from a company that's had its share of successes and failures, albeit during different times in the industry's history, that data is supremely important to help inform your decision making. And we never actually prescribed that the data would be anything more than a tool used for these leaders to make decisions. And we didn't say that it was the holy grail of right or wrong. It was just more informative. But if you can tap into that, we saw tremendous benefit. Again, ultimately, on the, with product development decisions, it's in the execution. But just building that trust and relationship and being there for folks in a supportive way and offering up our access to our resources basically for zero cost we didn't bill, we didn't do any interdepartmental billing for people's time or money or expense, et cetera. But just to know that it was all there, I think, created a lot of mutual trust and improved the working relationship, which to me is priceless.
It's sometimes not well understood, but sometimes at certain studios, I've seen like some really small dumb trick can like double D7 retention. And so, like, yeah, sometimes some
Yeah.
of that data is actually quite helpful.
Yeah.
And
And we did, by the way, I mean, another just tactical thing was to be able to allow these folks who were spending their hard-earned, dollars on marketing and advertising for us to include them in our master service agreements with the ad networks, to just give them some price, some price relief.
right.
So I think that was probably that was obviously quite tangible as well. So those kinds of things where you can, where you can identify, again, they're small in and of themselves, but they have tangible benefit.
And so Brian and Matthew, before I ask Chris about like the future outlook of M&A moving forward in the current environment, do you guys have any other questions you'd like to ask Chris?
Current thoughts on GameStop.
Oh, is it back now? What's his name? The day trader's
Roaring
back.
Kitty.
I mean,
Roaring Kitty is back and he's roaring. Yeah.
are we back in for another roller coaster? I don't know that there's any more energy left in the market for this. I mean, I think that was a one and done. I don't think that it's going to replicate itself.
I mean, I do have a question that ties into the future outlook for M&A, and it is also kind of talking my book as someone who works at a Roblox studio, but I still think for Roblox professional developers, it's still early. There's still a lot of things that have to be worked out as building on the platform, but, curious if you've thought about when these larger organizations have to take Roblox seriously as a platform and what that might look like from a industry structure perspective.
Oh, Matt, great question. Don't hate me for these answers, all right? Just, this is all part of the healthy debate. But I continue to be on the more skeptical side of large scale organizations investing in, or quote unquote, taking Roblox seriously. Obviously, you have what Netflix is doing, which I think is tremendous. And I think, reminds me of back in the day of Second Life, and when brands were going in there and creating virtual spaces for themselves. And when I was at Playboy, we created a Playboy bunny shaped island, and it was all fun, and we invested in it as we invested in marketing, right? It was all meant to be a new storefront for our brand to interact with users in a new and different way. And I see Roblox very much the same, because to me, the unit economics prevent any large scale companies from taking Roblox seriously. Because if you're going to invest or acquire a top tier Roblox developer, the financial profile is so at odds with your core business that you're ultimately going to create a lot of tension within your organization, from not just operations, but accounting and finance. And how do you invest in this growing business? But when you're earning 20 cents on the dollar, it's quite reversed in its logic. But I do think that UEFN, Roblox present tremendous opportunities for games and game companies that have brands to create extensions, right? We talk about franchise extension, transmedia, whatever words you want to use. And I do think that is where I'm most bullish about for our company and for others, is to look at these platforms as ways to extend your brand, just like you used to look at Discord and YouTube as a way to kind of create that. I think this is a natural filter through which to look at things. And in terms of acquisitions or exits, I can't help but think that the closer proxy for studios operating on Roblox as an exit is more what you saw with Meta and Oculus, like being kind of the sole acquirer of content creators for their platform, because there's such a uniquely situated platform of one, that there is really no other place for these people to go than to the platform itself. And I feel that Roblox could actually stand to benefit from that, because then their unit economics, improve if they're keeping 100% of what's going on, and they're more in control of the IP that's being created. So, but I don't see it as a broad-based opportunity for companies to deploy capital into for purposes of exiting those studios. But I do see it as a marketing platform for game IP.
All right, cool. So maybe before I ask that last question, Chris, maybe I could also ask you from a FunPlus perspective: are any of these three Embracer split off companies attractive to you? Are you going to make a bid at some point?
Look, we are. I mean, as much as I would like to say yes, because of our scale, we are still heads down trying to, get on the other side of the last couple of years, being a mobile first, 4X strategy centric company. And I think we're doing a tremendous job doing that. We also have pledged to ourselves that we are not going to be looking at external opportunities until and unless we raise external capital, because that's a great catalyst for us to have that dry powder and also signal to the market that we are, we are a serious acquirer. Because the one thing I pride myself on is actually not trying to negatively impact the relationships and reputations that I've built with the ecosystem. Mostly the people on the sell side, the investment banks, et cetera. I think those folks, there are a few things that they like less than people that are on their call sheet that never transact, right, or only just go into the data room to get data and then immediately extract themselves from the process, because then they're not being genuine, right? And I've told all the folks that I know in this industry from the time I started FunPlus, I'm like, hey, please don't consider me at the top of your call list for the time being. I will let you know. I'm always happy to provide feedback, but we're not ready to do any material transactions. And that way, when we do come to market, if all things go well, then we can be in a better position to actually be sincere in our signals.
Great.
Interesting.
All right. So final question, Chris. We're at the end of ZERP. We're in what seems to be a fairly challenging mobile gaming market and industry. We're seeing some scale back in terms of some of the roll-up companies like Embracer. And so what is the outlook, and what level of scale, how much activity do you expect in the near-term future?
So the one positive thing that I can see, and a silver lining on all this, is that there is an entire constituency of large scale financial institutions that are now leaning into gaming because of the fact that they have been priced out of the market for the last 3 to 4 years, leading up into COVID, which is the private equity firms, the sovereign wealth funds, et cetera, that could not compete with the public market multiples. And there is an intersection of those folks that also have a bull case thesis on the future of gaming and interactive entertainment. And so, there is no shortage of folks that are ready, willing, and able to deploy capital into gaming, mobile or otherwise. And we just saw the news today about the EQT and Keyword Studios, right? They're trying to finalize a deal after Keyword had said no twice. And EQT, one of the preeminent European and global private equity funds, right, continuing to up their offers because they see value. So I think whereas before we had a certain hose of capital that was driving a lot of the business, I think there's new and different hoses that are now coming off the sidelines and looking at our industry. And I think there's general feelings that the most of the dust up is behind us, and that we all as an industry are getting smarter and operating with the new goalposts where they are. And we're also doing things as an industry in terms of investing in platform diversification, going cross-platform, going off App Store. We're doing a lot of things to create sustainability for ourselves as an industry. And we are all unified, maybe with the exception of Apple and Google, as an ecosystem, and making sure that we all succeed, right? All of the value chain links are working together to make sure that we continue to thrive and persevere past these more challenges. Some people say challenging times, but remember, these are challenging times based on an abnormal global event that caused unintended inflated valuation. So maybe we're back where we should be. And the only thing that's been the unfortunate, kind of outcome of this has been the overinvestment by companies and people, right? And so, now we're going through that painful process. But I think once that has settled down a little bit, I think we'll be back into a good smooth sailing. Relatively speaking, smooth sailing is defined differently now, by the way, than it was before in terms of growth rates. But I think, we're poised for, we're still going to be the largest sector of entertainment, right? That's not going to change. So I think if you're betting a horse on gaming versus music versus books versus movies and TV, this is still where you want to be. And I think there's a lot of financial capital out there that believes the same, especially as the convergence is happening between gaming and IP and interactive entertainment, and the walls are falling down, and they're seeing this generational shift of digital natives, and the proportion of time that they're spending with gaming and gaming related activity is only going to continue to increase. So I think medium to long term, I think we're going to be fine.
All right. Awesome. Well, Chris, thanks so much for your time. Do you have a final message for our audience, maybe from a FunPlus perspective? If not, no worries.
No, just continue to do what you guys are doing. We have the most creative, collaborative industry that I've ever been in. We always talk about this thing of co-opetition in our industry, and it's so true. I've never seen such an industry that is so large in stature, yet so intimate in its community. And the fact that there are a lot of us out there working together, even though we work at different companies and in different capacities, really trying to share thoughts, best practices, ideas, suggestions, learnings. I think that will only continue to benefit us as an ecosystem. And I encourage it. And I've loved what I've seen. And we've all locked arms during these difficult times to try and come up with solutions and help each other. And I just hope that continues.
Awesome.
Thanks, Chris.
Yeah, thanks so much, Chris. Brian, Matthew, thank you guys as well. And for our audience, we will catch you next time. Bye, everybody.